You have shortlisted two life insurance plans. The premiums are similar and both insurers have a strong claim settlement ratio. Then, someone tells you to check the solvency ratio too. Suddenly, there is one more number to understand. What is solvency ratio in insurance? Where do you find it? And should it influence your decision? In this video, we will explain what solvency ratio means, why IRDAI requires every life insurer in India to maintain a minimum level, and how you can use it alongside the claim settlement ratio while evaluating an insurer. Every life insurance company makes a long-term promise to pay valid claims whenever they arise. Some claims may come next year, others may come decades later. The solvency ratio helps indicate whether an insurer has enough financial resources relative to the obligations and risks it carries. In simple terms, it is a measure of the insurer's financial strength and its ability to meet present and future financial commitments. A useful way to understand it is to think of a household emergency fund. Regular income may cover everyday expenses, but unexpected situations require an additional financial cushion. Insurance companies also need a cushion because claim volumes, economic conditions, and investment performance can change. The solvency ratio reflects the buffer available to the insurer after accounting for its liabilities and business risks. Technically, the solvency ratio is calculated by dividing the available solvency margin by the required solvency margin. The available solvency margin is broadly the excess of eligible assets over liabilities. The required solvency margin is the minimum amount prescribed on the basis of the risks undertaken by the insurer. You do not need to calculate this yourself, but understanding the formula helps explain what the published ratio represents. Life insurance is different from a short-term purchase. A policy may continue for 20 or 30 years, and the insurer must remain capable of honoring valid claims throughout that period. It also has to be prepared for unexpected claim surges, adverse market movements, or other financial pressures. That is why the Insurance Regulatory and Development Authority of India, or IRDAI, requires registered life insurers to maintain a minimum solvency ratio of 1.5. A ratio of 1.5 means the insurer has 1.5 times the minimum solvency margin required for the risks it has undertaken. The requirement is intended to support financial stability and protect policyholder interests. It is not a one-time test. Insurers need to monitor and report their solvency position as part of their regulatory and financial disclosures. Once you find a solvency ratio, start with the IRDAI benchmark of 1.5. A ratio above the minimum indicates that the insurer has a buffer over the prescribed requirement. Generally, a larger buffer suggests more room to absorb unexpected financial pressure. But this does not mean that the insurer with the highest ratio is automatically the right insurer for you. The solvency ratio does not tell you whether a policy suits your needs, how responsive customer service is, or how smoothly claims are processed. It is one measure of financial strength, not a complete quality score. It is also more useful when viewed as a trend. Checking whether the ratio has remained stable over 3 to 5 years can provide more context than looking at a single reporting period. So, use the solvency ratio to answer a focused question. Does the insurer appear to maintain an adequate financial buffer over time? Then combine that answer with other information before making a decision. Solvency ratio information is publicly available. One place to check is the IRDAI annual report, which publishes financial information relating to registered insurers. You can visit the IRDAI website, open the relevant annual report, and look for the life insurance data or solvency ratio table. Individual insurers may also disclose their solvency ratios in annual reports, financial statements, or regulatory disclosures on their websites. For example, if you are evaluating ABSLI, you can refer to its publicly available disclosures and the corresponding IRDAI data. Avoid relying only on comparison site rankings. Such lists often highlight premiums, features, and claim settlement ratio, but may leave out the solvency ratio. Checking the regulator's report directly gives you the published data without turning the exercise into a ranking contest. Claim settlement ratio and solvency ratio answer different questions. Claim settlement ratio or CSR tells you the proportion of claims settled by an insurer during a particular period. It gives you a view of recent claim settlement performance. Solvency ratio tells you whether the insurer has the financial capacity required to support its obligations and risks. A simple way to remember the difference is this. CSR looks at how the insurer has handled claims in the past, while solvency ratio looks at its financial preparedness to keep meeting obligations in the future. Neither number should be used alone. A strong CSR does not replace the need to check financial strength, and a healthy solvency ratio does not tell you everything about the claims experience. When deciding how to choose a life insurance company in India, consider both metrics together. Then review the product features, exclusions, premium affordability, service standards, and suitability for your protection needs. The aim is not to find one magical number. It is to build a more complete view of the insurer and the policy. Solvency ratio matters because life insurance may need to deliver on its promise many years after you purchase the policy. If you buy term insurance in your 30s, the cover may continue into your 60s. Over that time, economic conditions, markets, and claim patterns can change. You are therefore choosing not only a policy but also a long-term financial partner. Checking the solvency ratio cannot predict the future, and it cannot guarantee a particular claims experience. What it can do is help you understand whether the insurer is maintaining the regulatory financial buffer expected of a life insurance company. That makes it a practical addition to your evaluation checklist. Let's answer a few common questions. What is the minimum solvency ratio required for life insurance companies in India? IRDAI requires registered life insurers in India to maintain a minimum solvency ratio of 1.5. This is intended to ensure that insurers maintain an adequate financial buffer relative to their risks and obligations. Is a higher solvency ratio always better when choosing a life insurer? Not necessarily. A higher ratio indicates a larger buffer over the required minimum, but it does not measure product suitability, service quality, or claims processing experience. Evaluate it alongside CSR and other relevant factors. Does solvency ratio affect how quickly an insurance claim is settled? Solvency ratio measures financial strength. It does not measure claim processing speed. For a broader assessment, review both solvency ratio and claim settlement ratio along with the insurer's claims process and policy terms. One thing to do after this video, the next time you compare life insurance plans, do not stop at the premium and claim settlement ratio. Open the latest available IRDAI report or the insurer's financial disclosures and check the solvency ratio too. Look at the latest figure and where possible, its trend over the previous few years. You can apply the same framework to ABSLI or any other life insurer you are evaluating. Claim settlement ratio for recent claims performance, solvency ratio for financial preparedness, and policy details for suitability. No single number can make the decision for you, but understanding each one can help you make a more informed choice.